yours, then you want to make sure that you're employed, that you have good employment, consistent employment. Remember this, what the lenders are actually looking for is what we call 2, 2, and 2. 2, 2, and 2, remember that. 2 years of consecutive employment. One must have 2 years of working history. It doesn't have to be in the same industry, but it needs to be consecutive. Okay, so you can actually be a school teacher and then maybe go into another field, but it needs to be consecutive. But you want to make sure that it's in the same, like W-2. If you're 2 years W-2. So you can't be like a W-2 1 year, 1099 another year. So it has to be consecutive work history with the same type of taxes and everything, okay, in that. So W-2s, 2 years straight employment history, 2 years of filed taxes. A lot of times people are not filing their taxes. You will not believe how many people are not filing taxes. It's got to be filed and signed tax returns. Must be filed and signed tax return with the IRS for current consecutive 2 years. So you want to make sure that you're filing your taxes, file, sign tax returns. 2 years. That's what the lenders, whenever you come to me and you want to get a mortgage, that's what I'm going to be looking at. Are you employed? How long have you been employed? Are you working full-time? If you've been deployed for full-time, you're good. Have you filed your taxes for 2 years? That's good. And credit. Want to make sure that you have credit. Now, there are some programs out there where you do not have to, you can advance to the next screen, please, where you do not have to have credit. But if you want to take advantage of what we're going to be talking about later, it's what we call down payment assistance programs. You want to make sure that you have a credit score for that. But there are programs with FHA where you do not have to have a credit score, but you have to have what we call non-traditional credit. And non-traditional credit is whenever you're actually using if you're renting your lease, you're using your car payment. Well, not so because that would produce you have credit, but when you're using your insurance for your car, you're using car insurance, cell phone bills, water bills, things like that, non-traditional credit. So you can, but you want to make sure that you have a score. And what the lenders normally look at is that for different programs, the higher score, the better. So down payment assistance, it starts at 640. And I'll talk about down payment assistance a little later. But some companies, lenders, they can actually go down to 580. But again, whenever you're looking at a low credit score, you're going to look at a high interest rate. So the higher your credit score, the lower your interest rate. That would mean the lower your monthly payment that you're actually going to be paying, a month for your mortgage. So always want to try to get your score as high as possible. So what you want to start doing is budgeting for this, because there are certain things that you're actually going to need before you become a homeowner. There's closing costs that you may have to come out of pocket with. Closing costs, what we call due diligence. This is whenever a contract is actually signed. You want to pay due diligence. Due diligence actually lets the seller know that you're serious about the property, and normally that's $1,000. So this is why you want to budget. You understand now how all of this actually comes together with financial preparedness and budgeting. So you want to make sure, again, it is absolutely necessary to create and have a monthly budget. Budgeting allows you to track your income and expenses to make sure you are living within your means. We talked about that earlier. So you want to make sure that you're on a budget. You're budgeting for this. You just don't want to step out if you haven't did the necessary work as far as budgeting, because there are things that you're going to have in place. Lenders are going to be looking at that. Do you have a savings account? You're going to say, no, but this person don't have no money to put down on a home. So you want to make sure that you're looking at that. Again, build your savings. $1,000 for due diligence. Earnest money, that's another thing. Earnest money, you want to make sure that's going to $1,000. If you want to be competitive in the market whenever you want to make an offer on a property, so you want to make sure that you are able to put the money down where your offer is going to be accepted. So again, $1,000 due diligence, $1,000 earnest money, and then you have closing costs. There's closing costs. Normally, what you want to look at for closing costs, rule of thumb is 3 to 5% of closing costs, right? So you want to make sure that you have closing costs that you could actually, even if the seller does pay seller's concession, you still want to make sure that you have at least, in whatever amount you're looking at, 3 to 5% of closing costs actually signed up, put in your savings. So I would say roughly looking at $3,000, $3,500 to $4,000, and it may not even take that much because there's other programs that you can actually use to actually help you with your closing costs. But at least you want to have due diligence, earnest money. Maybe, I would say roughly, just try to have at least maybe 4,000 in your account, you know, whenever you're looking at to become a homeowner, okay? So you can take it to the next one, please. A budget. Create a budget. Make sure that you create a budget, that you have that in place. I'm always stressing this because whenever you don't have a budget, you're out there just doing any and everything. You gotta make sure that you are taking time to create your budget, your needs versus your wants. Whenever you become a homeowner, you can't do any and everything that you wanna do probably if you're renting, because there's responsibilities that you're gonna have to take care of when you become a homeowner. It's no longer on the landlord, but you gotta take care of that. If anything breaks down around the house, you have to pay for that, right? If you don't have the proper coverage to cover that, and I talk about that too, making sure that you're getting a warranty, homeowner insurance warranty. We're talking about that too. Once you have a homeowner's warranty to cover any breakdown of your appliances or structural damage that may happen to your home, you want to make sure that you have that in place. But sometimes you have to come out of pocket with certain things. That's why it's important to create a budget. Make sure that you're saving. Remember I talked about having a savings account and emergency funds? That's where your emergency funds actually comes in. You don't have to go into your savings, but you've been putting money back in your emergency funds account that you can actually come out of pocket maybe a little bit if some of those things are not covered by the home warranty. So that's why it's so important that you budget, that you be consistent with budgeting, that you learn this now before you become a homeowner, because all the responsibility now is going to be on you. It's not going to be on your landlord. You're going to have to take care of the maintenance of your property. You're going to have to pay property and taxes insurance. You're going to have to, if anything breaks down, like I said, you have to take care of that. So that's your responsibility. And again, having a budget will help you to be able to maintain, whenever that happens, to maintain that. So make sure that you're doing that now and that you're not trying to scramble around and create a budget whenever you become a homeowner. Put that thing in place now so that it'll be a smooth transition whenever you become a homeowner. Get that mental, get that mindset, get that behavior of saving and going by living within your means, staying within your means. Make sure that you're doing that. If you can go to the next slide, please. Remember I talked about earlier about the accounts. Could you advance to the next slide, please? This is what a lender is going to actually look at. Can you advance to the next slide, please?
Dennis, look at the next slide, please.
And remember when I was talking about budget, whenever you're budgeting, if you see that that's in a negative, you want to make sure that you go back and, hey, what can I eliminate? You know, I don't want you to think about, I don't want you to get so drastic where I can stop doing that. No, just gradually start tweaking things. Well, I can cut back on this, right? I don't have to go out and eat, 3 times out of the week. I can cut back on this, or I can cut back on that. So try those little things. Don't let it be such an abrupt change that you don't stick with it. Make sure that it's a gradual change. I did not go out for, maybe I just go out and eat once a week instead of 3 times out of the week. Maybe I'll eat lunch, maybe two times a week instead of every day of the week. So make sure that it's gradual so you can change that behavior. So the next slide that I wanted to talk about is the essential accounts that I was talking about before. You want to make sure this is what lenders are looking for. This is what I will be looking for. Any lender that you're going to go to get pre-approved, this is what they're looking for. You want to have a checking account. A checking account normally is where you pay your bills and you have your paychecks going into it, because the lenders are going to ask you, I need to see at least 2 months of your banking statements. And what they're looking for is that you have your direct deposit from your paycheck. They're trying to look to see how you're actually balancing and how you're handling, your monies, your finances. If they're looking at your banking statements and they're seeing you're always in a negative, you don't want that. So that's why I'm saying it's very important that you learn how to budget and that you stay within your means so that you have a checking account. It's always good, again, that you have a savings account. It lets the lender know, hey, this person knows how to manage their finances. You want to make sure that you have a savings account. These other two accounts right here is not necessary, but I just want to put it on there to keep in mind that this is something that you do want to eventually have. A money market savings account is where you earn a higher interest rate, and always, outside of your job, I want to stress this, outside of your job, make sure that you look into opening an investment account. But the first two is really what you need, is really what you have to have. You want that, because it's gonna look favorable to the lender that you have the checking account and the savings account. You can advance to the next slide. Now let's talk about this. I want to take my time with this just a little bit. In regards to your credit, this is a pie. Can you all see that? Yeah, you don't see it. All right, so this is how your credit, this is what we look at as lenders whenever it comes to your credit score. We're going to be looking at your payment history, and this is how these items weigh in order to determine what your score actually is. So sometimes your score can go up to 900, but mostly it's going to range from 800 to 850. That's an excellent score. That's what you want to shoot to. You want to shoot for that. 740 to 700 is very good. 670, 739 is good. 580 to 669 is fair, and 300 to 579 is poor. So usually right now, anything below 580, the lenders are not looking at. So again, the higher your credit score, the better. So what I would say for everyone, how many people know what their credit score is? Y'all know what your credit score is? Okay. So the higher credit score, the better. So if you can get your scores in the 700s, 600 is good, but if you can get your scores in the 700s, starting at maybe high 680 and higher, if you can be in there, then you'll be looking at a decent interest rate. But if you can get 750 and above, you're going to be looking at a great rate. It opens up a lot more opportunities for you as far as the different type of mortgages and what you actually can, what you can qualify for. So always remember to earn higher for that. A lot of times too, you can see people that have a great credit score, but yet a lot of their utilization rate, their debt to income ratio is out of whack. And what the debt to income rate, we'll talk about that later, I don't want to get too ahead of myself. But what lenders again are looking at is your payment history when it comes to your credit score. This actually makes up your credit score. The payment history weighs 35% on your score. So that means that you want to make sure that you are making your payments on time. You're making your payments on time. You're paying your payments on time. Can I just say that one more time, that you're making your payments on time? You want to make sure that you're doing that, because that is 35%. That's a lot. So you don't want to be late. You don't want to be late. If you think you're going to be late, give the lender a call and say, hey, something happened. Maybe they can take that payment and put it on the end, but you want to make sure that you are you're calling them, you're being responsible, and that you're making your payments on time. If you're not, reach out to the lender and say, hey, can you work with me? They may be able to give you a grace period, for you to actually pay that, and where it won't be reported to your credit score, to the credit bureau. The next one is amounts owed. You don't need a lot of credit. And that's what a lot of people think in order to get a mortgage. You don't need a lot of credit. I just got finished working with someone. He didn't have a score at all. This was last year. And so I'm going to be leaving here, going to Fayetteville, and we're going to start looking for properties. His score is in the 750. He only has 2 trade lines. Only 2. It doesn't take a lot. I told him, I said, we want to get you, I said, the first thing that we want to do is start giving you, since he didn't have credit, I said, let's do what we call a secured line of credit. And what a secured line of credit is that you borrow your own money. And so take $500, most banks should have this. Take $500 and open up a credit card. That's going to generate, once you start paying it on time, it's going to generate a score. And you want to make sure that you keep your utilization rate at 30%. 30% or less. I said, so what you can do is use that just for gas. That's what I did with my daughter. I actually got her an actual credit card because she was a student, credit card. But with him, I said, use it just for gas. Make sure when you get your statement, you pay it off. Keep it on the 30%. And he did that. I said, let's do that for 4 months. He did that for 4 months. And I said, okay, now that you have that, let's open up your regular credit card. because he had a score number, right? And I told him which credit company to do to open up your credit card. And so he did that. I said, okay, let's make sure you're making your payments on time. Same thing. Keep your utilization rate on a 30%. Use it for gas. Don't do anything else. He did that. And then we talked about getting a line of credit, but his score is where it needs to be. So he's qualified, has a decent rate he's got an approval, and he has a decent rate that he's actually getting, 750 credit score. And then we have to start working on his savings because he didn't have anything saved up. And this man makes over $100,000 a year. Y'all hear me? That's what I'm saying. That's what I'm talking about. We can make all this money and we have no idea where it's going because we're just spending it like crazy. $100,000 a year and he didn't have a savings account. I said, okay, we gotta change that. We gotta create a budget. And that is exactly what we did. Do y'all know how much money this man got saved up? Over $12,000. From a budget that he went from having nothing. So it's not that we don't make the money, we're making money, but what are we doing with it? We're not being intentional about how we're spending. We have to be intentional about how we're spending our money. We just can't, we gotta stop the bad behaviors. We don't have to drive the best car. We don't have to wear the best clothes. We don't have to walk in the best shoes. As long as your clothes looking good, as long as your car is decent, it's getting you from point A to point B, we don't have to, we don't just because you don't have to ride it. It blows my mind when I see these people with BMWs, and there's nothing wrong with mobile homes, don't get me wrong, there's nothing wrong with that. I'm not saying that it is. But when you see somebody that has a BMW or all this Lexus and everything, and then they're living in a mobile home or living in an apartment complex, I'm like, what is that? You don't have to drive it, just shift your mentality. You want to be an owner. You don't always want to be a borrower. You want to be an owner. Own it. You know, time you drive a car lot off the dealership, it depreciates in value. Time you drive it off, it's depreciating. A home is going to appreciate in value. It's going to appreciate. I'm actually talking to an elderly person right now. She's on a fixed income. Her home, as you know, taxes has actually gone up. Her monthly income was like $700 or something. But because her taxes and the property value has gone up, it increased her escrow account, which is $1,000. So that means the property value of her home went up. So as long as you're in a decent place, decent location, your home is nice, it's gonna appreciate in value. So you wanna own this. You wanna make sure that you're owning, not just always borrowing, not always having to give out money, but making sure that you're positioning yourself that you can start owning something and saving and making investments and making a difference in your life and a difference in your family's life. So I'm telling you, it makes a difference. And it's not difficult to do. So again, 30% amounts owed, that's how much you owe. So you want to make sure that you keep your utilization rate. You may have a line of credit, or you may have a credit card that's maybe $5,000. So you don't want to max that out. That's what I'm talking about. You don't want to max that utilization rate is at 100%. You want to bring that down to 30% or less. So don't max out your credit cards. Just because you can doesn't mean you should. Yeah, you got 5,000. You don't need to max that out. Why? I tell people, whenever you're traveling, credit cards are actually used for whenever you're traveling. You may have to book a hotel or something like that. That you don't want to use your debit card, because when you use your debit card, it's going to hold that money. It's holding it, and it's going to hold it for a while. And then if anything happened, then where it didn't come off, you're going to have to file a dispute, different things like that, and it may be a while before you even get that money back in your checking account. So that's one of the reasons why you want to have a credit card for whenever you're traveling. You need to reserve hotels. Don't use your debit card. Use a credit card. Because if anything happens, your money in your checking account is not being held up. So always keep that in mind. But just because you can, doesn't mean you should. Just because you got a $5,000, $10,000 credit card limit, don't use it all. 30% or less. 30% or less. The length of history, credit history, 15%. Now, once you do have your credit card, your trade lines and all things, you want to make sure that you keep those open. Don't close them down. Don't close it out. You can put it at a zero balance, but don't close it. If you close it, you lose your history. And history counts as 15%. Remember, all this is going into play with your credit score. That's making up your credit score. So many times I work with people that say, well, I paid this off and I close. I go, oh no, don't close it. You're working on paying off credit, leave it open, but don't close it out because you lose your credit history. And 10% is new credit and types of credit. So what lenders are looking at, that you have a mixture. You have a mixture, you have installment loans, you have credit cards, you have revolving credit, you have lines of credit. They're looking at a mixture that you're able to handle all these different types of credit. So those are the things that actually makes up your credit score. And so the three major credit bureaus is Experian, Equifax, and TransUnion. One of the main things that most banks actually use is probably Equifax. I know the company that I work for, we actually use TransUnion, but these are the three credit bureaus that the lenders are looking for, and what they do with this is they do a tri-merge. They do a tri-merge. So your credit score, you may look at it and see where Experian may be reporting your credit score, say it may be 750. Equifax, you may get it, and it's actually saying that it's 735. And then you may look at TransUnion saying it's 700. And so what the lenders are actually going to do is take a tri-merge. They're actually going to take that middle score. All right, so you want to make sure that's why it's important to try to keep your score as high as you possibly can. So if you have a 735, and I think I said 750, and the other 725, so they're looking at that 735 score. They're going to take that middle score. So always try to work on getting your credit score up as high as you possibly could. So again, if you haven't, when was the last time you all checked your credit report? Do you all check your credit report on? Okay, so what you want to do, you can actually go to www.annualcreditreport.com and you can get a free credit report. Because you want to make sure that you don't have anything that's on your credit that shouldn't be. You want to make sure that everything is reporting correctly, that they have your information right. There's something that's not showing up that's surprising to you. I've come across that as well, where someone, this is not mine, I didn't do that. So then there's things that we have to do in order to get that off, filing different disputes and whatnot. So again, remember that, go to www.annualcreditreport.com. You can actually get your free credit report for once a year. Does anyone have any questions about that?
I'm sorry, the www.
www.annualcreditreport.com.
Okay,
Or you can call the 877 number, 877-322-8228. So,
okay.
all right, so the other things that I want you to think about whenever, this is what lenders actually look for whenever you're applying for a loan. They're going to look at capacity, capital, credit, and collateral. What does all of that mean? Capacity, the lenders are the creditors are looking to see if you have the capacity to actually repay the loan. So that's why I said the first thing you want to begin is that you're employed. They're not going to give you a loan and you haven't been consistently employed for at least 2 years, that you are employed and that you have been employed consistently, that you have the ability to actually pay that loan back. Capital is another term for cash and reserves. They're looking to see again, like I said, that's why it's important to have your savings account and start putting money in there. Does this person have a savings? You can advance to the next screen, please. Does this person have a savings? Have they been saving? And so that looks very favorably to the lender. So you want to make sure again that you're doing that you're saving your money. If you need to start at $25, $10, just start and be consistent in making sure that you're funding that account every 2 weeks, whenever you get paid. If you get paid once a month, then if you get paid once a month and you do $10, if that's where you need to start. But that should not be an ending point. You should be progressing from there, because realistically, you're not going to get to where you want to get to if you're just funding your account $10 a month. It's a good starting point, but it's not a place where you want to stay. You want to advance from there. Credit. Lenders will review your credit history to determine your overall credit worthiness. And what I like to tell people, that credit is actually integrity. It's actually integrity. You're actually doing what you promised the lender that you were going to do. You got a car. I know life happens, right? Life happens to all of us. Trust me, as I told you my story earlier, life happens. But you want to make sure that you're integral, that you tell the lender, I'm actually going, if you give me this car, this is how much I'm going to pay a month. So that you're being a person of your word, that you've been integral about making your payments whenever you agreed with the lender that you're actually going to do that. So that's what the creditors are looking at. They're looking at the pie chart. Remember the pie chart that we just went over? That's what they're looking at. And then the collateral. Whenever you actually go to get your loan, and you've made an offer on your property, they're looking at the collateral. What are you going to, for me to actually give you this loan, I want to make sure that I have a collateral that's actually going to back that amount for me actually giving you the loan, and the collateral is going to be your property. It's going to be the house that you're actually looking for, or that you're trying to acquire. Just like I said, it's important for you to vet your bank. It's also important for you to vet your lenders. It's also important for you to vet your lenders. Whenever you get in the process of where you're actually ready to move forward with getting a mortgage, and lenders know that, you have a 30 to 45-day window where you can actually go into what we call shop for rates, or mortgage shop, to see which lenders are best. So, and your credit score will only be affected one time. You have that window. So you want to make sure that you vet your lenders. Whenever you go to talk to a lender, just let them know, hey, I just want to see based upon, and you just say it verbally, based upon my information that I give you, I know that my credit score is 700. I have no debt. This is just a hypothetical. I have no debt. My credit score is 700. I have a savings, where I saved up maybe 3,500. And I've been on my job for 5 years. Based upon that, what kind of loan do you think I can qualify for? What kind of interest rate am I looking at? You can ask a lender that without them actually having to do an actual application. You can do that. And then when you know that you're actually ready to move forward, then they would do what we call, they can actually do what we call a pre-qualification. A pre-qualification is not worth the hill of beans, people. It's not worth the hill of beans, because it's just verbal information that you're giving the lender. When I, as a realtor, whenever you say, well, I'm pre-qualified, that doesn't mean anything to me. It really doesn't. It doesn't even, the weight of paper has no weight to it, because it's just verbal information that you've given to the lender. Nothing has been verified. You just tell the lender, they just put this information into the system, and nothing, you haven't given them no pay stubs, you haven't given them any banking statements, you haven't given them no tax returns. It's just verbal information that you've given them. So pre-qualification is really worth nothing, right? So it can let you know personally what it is that you're looking at, but as far as whenever you're serious about moving forward to start looking at a home, you want to make sure that you go beyond that and you look at doing what we call, the next one is a pre-approval. A pre-approval is when a mortgage application has been completed and signed, it's been taken by the lender, it's been entered into the system, it's been signed by you all, the documentations have been verified, your income, your residence, your tax returns, and your credit has been pulled. That's what a pre-approval is, and that's what a realtor as myself, that's what we want. So we can actually say, okay, now this person is actually ready to start looking for a home. Because nobody, now I did this when I was a novice, I didn't even let people get pre-approved. I was just driving them around without a pre-approval. So I know better. Once you know better, you do better, right? So you want to make sure that you're pre-approved. Okay, so that's what a pre-approval. The best pre-approval is good, very good. But the best one is what we call a verified approval letter. It goes beyond that. It goes beyond the lender taking the application. You sign the application, all the documents and everything have been verified, but it's going to be submitted to the underwriter. And then the underwriter is actually underwriting that loan at that particular time. And that's a verified approval letter because it's already been underwritten. So whenever you really go to actually find the property, it's really not a lot that you have to do because you've done most of the work already. So that's one of the key ones that you actually want to make sure that you can get those two, pre-approval or verified approval letter. Can you go to the next slide, please? Does anyone have any questions? So once you get to that, so now the mortgage representative is gonna be talking about the various types of loans that you may qualify for. There's 4 different types of loans, what we call a conventional. You know, he doesn't, if you can advance to the next screen. Oh, yes.
So if these individuals want that pre-approval or that verified approval, you help them and direct them where
Yes.
to go, or do they select where they want to go themselves?
We have the conversation where we can actually get the verified approval letter and let them know we can do a pre-approval or the verified approval letter where you have to get all the documents to me, sign everything, and then we can submit it to the underwriter. And once we submit it to the underwriter, they send that back to us, then that verified approval letter is generated. Mhm. So these are the 4 types of mortgages that you can actually get: conventional, FHA, USDA, and VA. A conventional loan, that's one of the, all these are good, so it just depends on what your situation is. Let me start with at least one that's not as, a VA is that you're a veteran, or you would be the spouse of a veteran. And they normally do 100% financing. That's really, really good, right? 100% financing. It's a government-backed loan. There is normally, like I said, 100% financing, and they can go as low as 580. Yeah, but again, the higher your credit score, the better. So you're gonna be looking at a high interest rate. So just kind of keep that in mind with the VA. And there's a lot, I'm just giving y'all a brief synopsis about these because it's a lot that goes into these loans. It's a lot that goes into them. So the next one is a USDA loan. A USDA loan is backed by the government, and it's usually a 30-year fix. It's designed for low to moderate borrowers, and it's in a rural suburban area. Again, it's 100% financing. The credit score is normally 620. So I'm actually, and it's based upon your median income. So if you make, for my guy, who I'm actually taking to look at properties today, he makes $100,000 a year. So he doesn't qualify for that, because even though he's in the Fayetteville area, he's just a single person, but it's out of the median income. He doesn't qualify for that, it's out of the median income. So you gotta make sure that whenever we go to do that, we look at a chart and we see what, and a lot of times they too rearrange this depending on what year it is. Every year, they rearrange it as far as what your median income, to see if you actually qualify that. So that's per household. So if you may be in, and I'll just say Aberdeen, where I actually live. So the median income for Aberdeen is probably like $150,000, because it's more, the property value there is a lot higher. So that's why you're looking at it. So they take all of those things into consideration. So that USDA is based upon your median income. So kind of keep that in mind, but it's 100% financing. And the other is FHA. FHA is a government-issued mortgage designed for low to moderate borrowers. It requires a 3.5% down payment, and they're lenient on their credit score. It's normally 580. They don't have what we call, they do not have private mortgage insurance, but they have what we call MIP, mortgage insurance premium. So you still, and that's actually for the life of the loan. And like I said, I don't want to get too deep into a lot of that, but I want you to know the different types of mortgages that you can actually qualify for. So that doesn't require a lot, it's only 3.5% if you want to do FHA. And that is a fixed rate. VA is fixed, FHA is fixed, USDA fixed. Conventional, this can be fixed or variable. That's a fix. It's normally a 30-year. The credit score on that is minimum of 620. With the conventional, you normally have to put at least 5% down. And it's a little more stringent than the other ones. It's a little more stringent. So it's, the criteria for that, for the conventional, is a little higher and stringent when it comes to that. But whenever you make an offer on a property, this is something that sellers actually look at. They can look at to see, if what type of loan. That's why it's important to get a pre-approval and a verified approval letter. Because the seller is looking at it, especially if it's, competition, where you have other people that's actually bidding, you know, have offers in for that property. If you have a strong credit score and you have money that's actually, you know, money that you've saved, and where you can actually, you're more competitive. And so if they look and say, hey, this person's getting a conventional loan, that means they have strong credit, that this is really, really good, so they're a solid candidate. So I know this is probably more than likely this will go through. But if you were to look at somebody who probably has a USDA, they know that person is a low to moderate borrower. So they may be a little iffy, you know, when it comes to actually accepting that person's offer. Do you understand what I'm saying? Conventional is strong. This is a strong candidate. They're looking good, so I know more than likely this is gonna go through. USDA, that's a little iffy. Low to moderate income person, credit score is probably not that great. So they may have some challenges when it comes to maybe even when it comes to underwriting or something like that. So the sellers actually look at that. That's why a pre-approval letter is necessary, not just for the realtor, it's definitely for the realtor to make sure that you qualify to purchase a property, but whenever they submit that offer to the buyer, the seller's agent, they're gonna be looking and say, hey, what type of loan does this person have? So that's why it's important to you to make sure that you're working on your credit, you're saving, you know, you're building your credit, you have a high credit score, and you have a healthy savings account, so that you can make sure that you get the best loan that you actually need to get. Any questions on that?
Is that information, shared with the seller or just the representative of the seller?
Just a representative of the seller. It is shared with the seller, because they wanna, yeah, they wanna see that. That whole package, it's the offer to purchase is presented along with, the pre-approval letter. Yeah. And the seller wants to present that, hey, this person is qualified to actually purchase this. You know, because that's gonna make them determine if we need to accept this offer or not. A lot of times they say, well, it could be contingent upon this person selling another property, and they go, no, we're not doing that. You know, so yeah.
But, what if you're someone that, let's say you qualify for conventional, but you like the benefits of USDA or FHA or VA? You see what I'm saying? So, you know, I mean, I might qualify for conventional, but I don't wanna put 3.5% down.
Right. As long, just keep this in mind, as long as the property that you're looking at, it may not be where it's competitive.
Okay.
It may be where it's just you have that offer, but you really won't ever know that. But if you feel better with actually going the USDA route, then do that.
Right.
I always believe what God has for you is for you, right? So yeah, if that's where you feel comfortable with, do that. And it may not be where that person has a lot of offers that's actually coming through. So do that. Do what's gonna actually work for you. Any other questions? Okay, can we advance to the next screen, please? Remember, I briefly talked about this non-traditional credit? So there are loans out there where you don't have to have a credit score, but they look at non-traditional credit. So you just have to make sure that you're able to provide, like I was saying, you know, your rent payments, your utilities, you know, car insurance, cell phone bills, different things like that. And there's a little more that goes into play when it comes to non-traditional credit, but you can if you don't have a score. There are loans out there where you can actually use what we call non-traditional credit. That is definitely possible. To the next screen, please. And down payment assistance. It is so much money out there that can help you, that can help borrowers with their down payment. Down payment assistance, remember I said this requires for you to have a credit score. And the minimum is normally 640. So the down payment assistance program is provided by state, local government, nonprofits to lenders to assist borrowers and help to fund their loan for the purchase of a home. So with our current, administration, I don't know how long these are actually going to be in place, because every year they go to, like I said, to the lender, to nonprofits, to governments, to banks, to let them know, hey, this is how much we actually have now that we're going to be giving for DPA, down payment assistance. You have have down payment assistance at $17,500. You have one that's $15,000. You have one that's $50,000. Fayetteville, North Carolina has one that's $25,000. So there is a lot of different DPAs that's out there. They can really help you when it comes to your down payment, and you can use that any way you want. You can use it to buy down the loan amount. You can use it for your closing costs. Remember I talked about, you know, your closing costs. You can actually use it to that. So just at least have, like I said, $3,500 or something like that in your savings in case you may need it. You may not. If you have the down payment assistance program and you qualify for that, you may be able to get, you know, the $50,000, and those DPAs can be stacked. They can actually be stacked. So you can get $50,000, then you can get $30,000 or $25,000. They can be stacked, and that can actually lower your loan amount. I'm actually working with a girl now, and she's part-time, and she qualifies for down payment assistance. Did you hear me? She's part-time. So I'm telling you, there's no reason why you can't get a home. If you're doing the work to position yourselves to be able to purchase, you can get a home. And it doesn't, and this is why I try to explain to people too, it doesn't have to be your forever home. Don't try to get something that's, well, I want 4 bedrooms and this does not have to be your forever home. You can use that to build. You can use it as an investment property, use it and then sell it, take that money, put it down on a better home that you may want. But just keep in mind, it doesn't have to be your forever home. It doesn't. But it's a lot of money out there that's there to assist you. And make sure that you're taking advantage of that. There's so much that we're missing out on. So much. So much that we're missing out on. Because we don't know, you know, again, my people in the store for lack of knowledge. It's just because people don't know. They just don't understand what to do and how to do. Any questions about that? Any questions on that? You won't know. You won't know until you actually put in an application with the lender.
Okay.
Because they have to pull your information. They have to look at your income. Remember I said these are income-based.
Okay.
Yeah, they have to look at your income, look at your employment history, make sure that you know, that's in line, making sure that you file your tax returns, and look at your debt-to-income ratio. Because some of these do have to have, like, you have to have a debt-to-income, I'm going to talk about that probably in the next screen. Some of them require that your debt-to-income ratio, like you have front-end ratios and back-end ratios. Your front-end ratio is really based upon your mortgage payment, how much you have, you know, with your mortgage payment. So a lot of times the front end is low. So like you can't be over 35% or something like that, or 38%. Your back end ratios, these are just revolving credit, everything that you're actually paying out. Sometimes those don't even have a cap. You know, sometimes it may have a 50%, 40%. So the lender, you wouldn't know, the lender, right, once you do that application, then the lender will be able, after everything that you've given them, they put everything in, pulls your credit, they'll be able to tell you, hey, you qualify for this, you qualify for that. Yeah. Good question. And I'll just kind of, the next screen, please, thank you. Does someone have a question? The next screen, please. Understanding debt-to-income ratios. This is what I just talked about. The debt-to-income ratio, better known as DTI, you may hear lenders talking about that. The ratio is a key financial metric that compares your total monthly debt payments to your gross monthly income, which is expressed as a percentage. Lenders use this ratio to assess your ability to manage debt and determine your eligibility for a loan. A lower DTI generally indicates a healthier balance between income and debt. And that's what the lenders are looking for. Again, they want to make sure that your debt-to-income ratios are in compliance. That's why I say get in the habit now of saving. All of this goes hand in hand. It really does. All of it goes hand in hand. So get in the process of saving, that you're not spending everything that you make, right? That you're not out here getting all this credit, stuff that you don't need. You know what I'm saying? If you can't pay cash for it, you don't need it. Some things like a car, yeah. You probably need to get credit for that. not too many people have, 20,000 or 15,000, something like that, to come out of pocket for a car. So yeah, you need that. But other things, again, take that 30-minute pause. Is this something I really need, or is this just something I want? What is the bigger goal? What is my vision? Remember I talked about the vision. What is my vision that I'm actually trying to achieve? If my vision is to become a homeowner, then this stuff can actually wait. It's not really necessary. Let me get into the place where I want to be first. Let me get settled. And remember this. I always express this, and I've had this happen one time, but I express to customers, whenever you start your loan process, do not go out and create any more debt. Don't go out and try, hey, I want to buy furniture for my home. No, because you're messing up your debt to income ratio. That can knock you out of the water. It can mess everything up. You could be like a 0.1, 0.01, or 1% off of your debt to just knock you out of compliance. So once you start the process of home ownership, no more debt. Don't go buy anything. You can pay, continue to pay on your debt and everything like that, but do not go and purchase new debt. Don't do that, because it can mess you up from actually closing on your property. So remember, debt to income ratios, this actually determines how well you're actually managing your credit. So you want the lower your debt to income ratio, the better. Because that helps you to be able to qualify for a larger loan amount. Listen to this, just because you may qualify for a $400,000 home, it doesn't mean you have to buy a $40,000 home.
Right, that's right.
You qualify for it, you know what you want your monthly payments to be. So like whenever you go to talk to a lender, hey, I don't want my monthly payments to be over $1,500. So the lender knows, okay, well, this is what you qualify for. So you want to make sure that you're doing that. Just because you qualify for 400, 300, whatever it may be, it doesn't mean you have to go to the max on that. Live within your means. You do not want to be house poor. You want to enjoy your home. You want to still be able to live, not just exist. You want to live. A home should be an asset, should be enjoyable. Something you can come home, a safe haven that you can relax and celebrate. Say, hey, I did this, we did this. So keep that in mind. Just because you qualify for that amount doesn't mean you have to go for the max. Any questions about that? How much time do I have left, Pastor? 5 minutes. And types of mortgages. Types of mortgages. These are the different types of mortgages that you have. I recommend everybody get a fixed mortgage. Fix, you hear me? Fix. What happened back in 2008, this is a little before I actually got my mortgage license. Predatory lending. Predatory lending happened in 2008. That's when the market crashed. People could, it's what we call A, B, C, D, and E credit. A credit was where you could have an 800 credit score, 850 credit score. If your credit score was great, they didn't verify nothing. They didn't verify your income. They just took your credit score and say, okay, this person got A credit, so we're gonna give them a mark. They didn't look at your debt to income ratio, none of that. None of that. Some people got into what we call an adjustable rate mortgage. Adjustable rate mortgage, it starts out low. That's what a lot of lenders did. That's terrible. But adjustable rate mortgage actually starts out low. And then in 3 to 5 years, it increases. Your interest rate could be like 3%. Then it'll jump, maybe to 8 or 10 or something like that. And what did that do? It affected their monthly payment. So it knocked them out. They weren't able to pay that. That's when the market crashed. That was predatory lending. It could also, too, whenever, they looked at a home, they have now what we call their appraisal. What they have now known a non-arm's length transaction, that an appraisal cannot be affiliated or associated with any type of lender. Because what used to happen is that the lender would get up and say, hey, I need this appraisal to come in at such and such and such. Okay. They put the appraisal house, maybe not even appraised for that. That was predatory lending back in 2008. That's why the market crashed. And now, so everything was strict, right? The guidelines now is starting to loosen up quite a bit, but that's where it was strict. So they went from one extreme to the next. Now it's starting to loosen a little bit. But I encourage you all to always get a fixed mortgage, okay? If you're savvy and you understand how the mortgages actually work, and if you're savvy, you understand it, then you can look at doing the other ones, but I just encourage fixed rate mortgage. The fixed rate mortgages are stable and offer long-term savings because the interest rate never changes, the monthly principal and interest payment never changes either. Your payment could go up a little higher as property tax and insurance costs go up. Just like I told you about the senior lady who was on fixed income and the tax values actually went up, so that affected her payments, her monthly payment, her escrow. But normally your principal and interest, that's fixed. But your escrow accounts, that can go up because the tax values are increasing. Okay, so that's gonna affect your payment. So keep that in mind. Interest-only mortgages, that's where you're paying interest only. Again, if you're savvy and you know how this works, because what happens is that you start to acquire what we call negative amortization. Your interest rate, you're only paying interest, you're not paying anything towards the principal. It's just interest payments. So interest, instead of paying part of the principal, the loan amount each monthly plus each monthly interest charges. Interest-only loans require the borrowers to pay only the interest for the first 5 to 10 years. Afterwards, the borrower must start paying both the principal and the interest. Right, so during that time, you got all this principal accumulating. It's accumulating. So you gotta make sure that you have a lot of money or you'll be able to actually pay that. So again, I don't recommend that. Doing an interest-only loan, it is out there, but I do not recommend it at all. Adjustable rate mortgage, it's just what I told you before, with the predatory lending, it's where your payments, it's called an ARM, A-R-M, stands for adjustable rate mortgage. It's when your interest rate starts out low, and then within 3 to 5 years, it's gonna increase, which is gonna affect your payment. Now, if you're in a place where, hey, with my family, like you may be in the military or something like that, my family, that's why you should get a VA loan. But you may get an ARM, it may be a VA loan with an ARM rate. We're gonna be moving in 5 years, so we know we're probably gonna sell our home. And you wanna make sure that you're able to sell your home. So it's just a very, very sticky situation. That's why I said if you're very savvy when it comes to mortgages, and you know how that works, and you know what income you're gonna be getting in, you know if you have somebody that you know gonna be able to purchase your property or something like that, and then something might happen where that doesn't happen. I just don't recommend that. But people still do it. And they, their rates adjust, and it knocks them out of that monthly payment, and it's sad to see that, but a lot of some lenders back then, they really put people in arms, and it wasn't pretty. And the balloon, you have a balloon mortgage. The balloon is sometimes called a reset mortgage. It's where, it's a good choice for home buyers who don't expect to own their home past the maturity date of the balloon, and it's where everything comes due. They're calling everything due, at the end of the loan. So that's what a balloon mortgage is. Does anyone have any questions about that? And whenever you're actually, going to apply for mortgage, make sure that you're actually lender. Is there a prepayment penalty? You can advance to the next screen, please. A prepayment penalty, it kicks in when you're paying the loan off before the maturity date. Or you're paying half of the loan off, 20% before the maturity date. And it says they can actually, a prepayment penalty fee, they can actually charge you for that. So that's some things you want to keep in mind whenever you're actually getting a loan. Ask the lender, if I were to pay this off, because what I encourage customers and borrowers to actually do whenever you're making your monthly payment, pay extra towards the principal. If you can pay extra towards the principal, you do that on a consistent basis for at least 5 years, you can cut from a 30-year mortgage, you can cut it down to a 25-year. And keep doing that, from 25, you can cut it down to 20. So make sure that you make your regular payment, and then you take at least 100, 150 or 200 and put it towards the principal. And you want to make sure that whenever you make the payment, you tell the person, this is going to the principal only. So it's applied to the principal. and then you'll see it start cutting your mortgage down 5 years. Right, so you don't have to actually have a 30-year mortgage for 30 years. You can accelerate that by paying extra towards the principal every month. Just make sure that that's consistent. Any questions about that? And time of disclosures, one of the things that you're gonna get whenever you actually do an application, you're gonna get, disclosures, which is loan estimates and closing disclosures. Those are gonna have to, those go to you, and they have to go to you at a certain time. You have to receive those within 3 days, because it's what we call RESPA within the real estate market. We have to release that information to you within a certain period of time to disclose everything, all the costs and everything that has been associated with the loan. And this is another thing too, whenever you actually get that, you do a pre-approval, that has to go out, so you can actually see, and you can compare with other lenders, that you may have been vetting. You can actually compare, okay, how much are they charging me for this, for that, and you might say, hey, what is this, what does that mean? So those are things I can talk to you about, or your lender should be able to say, this is what this is what that is, and it lets you know how much your loan is actually gonna cost, and it gives you how much you're gonna have to actually bring to closing, if you have to bring anything at all. So disclosures, that's on the next screen if you can advance this, disclosures have to go out to you once you put in an application, and you wanna make sure that you are paying attention to those disclosures, because it's gonna expound and it's gonna show you everything that you're paying for, your taxes, your insurance, everything is gonna be on there. What the lender is gonna be getting, what if you were to bow down your rates, how much that will cost. All those things are gonna be on the loan estimate and the closing disclosures. And so making sure that you're actually reading those. And that was actually passed in 1974, where it's mandatory to send that out. It's mandatory. So I think the next screen is Q&A. Yeah. So you can go to and advance to the next one. So any questions?
So how do we, what do we need to do to work with you? Just call you, set up an appointment?
That's on the next slide.
Okay.
You have cards?
I have some cards, yes. ma'am.
Okay, great. I'm wanting to know, these steps, is this for land as well, not just mortgage? Because I own my own home, and I'm interested in land.
You said you own your own home?
I do.
So this is for mortgages, because I don't
Okay.
do land loans. Most banks don't do land loans anymore because of foreclosure. Most people let their land go. So it's very difficult. You're gonna have to put down quite a bit, but yeah. But no, it's
Well,
just for mortgages.
it's home. I own, land, yes, family land.
You own the land?
Yes,
Okay, so it's not a land loan. Okay, so, but you asked me for just for, okay, maybe I misunderstood.
You said, she sounded like she said she needed land.
Right, that's what I
I
thought.
have land. We have land, my
Okay,
family.
okay.
And I own my own home, so I'm just inquiring on how to go about getting my land.
Okay.
No. It's over an hour away. Past it.
So you have some more land that you want to purchase?
No,
No, I'm misunderstanding. Oh, you have land you want to sell?
no, I'm trying to, I own my own home. It's a mobile home. So I have options whether to leave my home where it is, that I own,
Yes, ma'am.
and leave it for my children,
Mm-hmm.
and build my dream home on my land.
Okay.
So that's where I'm at. And I'm just kind of wanting to inquire on how to go about purchasing, retrieving my own personal land that I have. How would I
You
go
want
about
to
it?
use your own.
Yes,
Oh, she can help you with that.
yeah.
She
So
wants to
tell,
build a
explain
house.
to me.
She wants to build a house on some land that she already owns.
Yeah, I can help you with that. Yeah, so this is, yeah, so this is the mortgage piece that you
Right,
have to do.
I know.
Yes,
I know.
ma'am. So, yeah, I can help you with that.
Okay.
It will be the same process as.
Well, that's what I was saying, okay.
Yes,
thank you.
ma'am.
All right.
I'm sorry.
Yes.
Absolutely, yes.
Yes, yes.
And it's a process, you know, I want people, once they get it, I talk about too, this is not even about the homeownership part, the homeownership part is totally different, you know, but I talk too about making sure that you are covered, because I do insurance. One thing I've learned is that when people pass away, they don't have proper insurance coverage for their home, they wind up losing it. So that's another thing, you gotta make, that's a whole other thing too, but you gotta make sure that you have life insurance, you know, because if your spouse or anybody were to die, that income is gone. So you wanna make sure that you're taking care of that, that person won't have to struggle, your family won't have to struggle. God forbid, it's just like you have an insurance, right, for your car. If anything happens, it's there if you need it. Just like that, if anything happens, it's there if you need it, you know, so if someone were to, unfortunately, you know, pass away, you wanna make sure that you have income replacement there for them, so that that income can still be, the house payments and everything can still be taken care of, and your family won't have to be displaced. So I try to educate people on that as well, that whenever you get a mortgage, you gotta increase that if you have it. If you didn't have it, you need to make sure that you're increasing and cover that in case unexpected, untimely death or something, yes. Yes, sir.
It's like, years ago, my uncle passed away and stuff, we had like home insurance, on that, currently, living now.
Mhm.
So when he passed, that, they would kick in, covered over all the expenses involved on it.
It depends on what type of loan he has, but no. The home insurance, totally different. It covers your home in case anything happens to your home. Like if your home caught on fire or tornado or something like that. That's what the home insurance is for, any structural damage. This is life insurance.
Oh, life insurance.
If they passed away, you know, and if if he had a mortgage or something like that on that property, and if he passed and nobody's there to make those payments, the home's never going to foreclosure.
Oh, no, it's like, he go for.
I'm just giving you an example.
Okay, yeah.
Yeah. Yeah. Yes, ma'am.
I own my mobile home.